biggest story wasn't the jobs report this week because yesterday afternoon, mortgage bonds suddenly got a big boost after President Trump said that he'd be instructing Fannie Mae and Freddie Mac to buy a large amount of mortgage bonds. And that move does directly support lower mortgage rates by increasing demand for the exact bonds that mortgages are priced off of. You can kind of think of it like when, basically there's a big buyer stepping in, so prices rise and yields fall. But mortgage rates follow those yields lower, and that's why rates improved quickly even though Treasury yields barely moved themselves. And this move does also explain why rates fell despite, mixed economic news that we've gotten. The bond market's just basically saying policy matters more right now, especially something major like this. And that said, there is a trade-off. Buying mortgage bonds can lower rates and boost affordability in the short term, but it can also fuel higher home prices and add inflation pressure if it gets overused, which we have seen in the past. So yes, it does help mortgage rates in the short term, but again, mortgage rates follow inflation, so all this money printing will probably catch up to rates eventually. And now about the labor market, the main jobs report did come in weaker than expected, and on the surface, job growth did look positive, but nearly all those gains came from sectors that don't really tell us much about economic strength, things like healthcare and holiday-related hiring. And if you were to strip out those jobs, then growth was basically flat or even negative. And other reports that we got this week backed that up as well, showing fewer job openings, slower hiring, and just more people stuck in part-time work because full-time jobs are harder to find. And that kind of labor market cooling does usually help mortgage rates because it reduces wage pressure and inflation. Plus, if the Fed does finally acknowledge the labor market's weakening, then there's more reason for them to cut since that's what they've been citing. And on housing supply, builders have clearly pulled back more recently, and that is going to lead to even more of a supply shortage, especially if rates come down. We saw housing starts and permits both fall, which just means there's fewer new homes coming to market. And again, that matters because if rates fall and buyer demand picks up, but supply is shrinking or already small, then prices are more likely to rise again. And on the inflation side, we continue to get news from rents that's good. New rent prices are falling. We're seeing rising vacancy times, and rentals are taking longer to lease. So since rent does make up a big chunk of inflation, this is exactly what needs to happen for inflation to keep cooling down. The catch is that it does show up really slowly in the official numbers like we've been seeing. But what this all means is basically mortgage rates did move lower this week, mainly because of policy and headlines, and the labor market is continuing to cool. Inflation pressures from housing are easing a little bit, and supply does, of course, remain tight. And the combination of all that really makes rates easier to push down, and it will likely lead home prices to move higher again once demand does return. And looking ahead, next week is packed with info, but inflation's going to be the big one. And if that comes in soft, it could, reinforce this move lower and potentially change the tone of the Fed. So have a great weekend, and I'll see you next Friday.